interest revenue primarily. So you don't need to know how to do this now, but you will here in a couple weeks. But what you do need to do is example number 2. So example number 2, this is an example of equity securities that are going to be trading. The accounting for debt security that's trading is very similar. There would only be some small differences, and so we're only going to look at this one category with equity. The only differences would be interest payments would be received instead of dividends, but other than that, it's exactly the same thing. So we're going to do trading in this example. After this one, we'll do an example with available for sale, and you'll see that they are pretty similar. There's just going to be a couple slight differences that we have to deal with between those two categories. So in this example, we're going to assume that in year A, Kimball Corporation's first year of operations, during this year, they purchased 3 equity securities that are properly classified in the trading category. So what do they have? What has to be true for them to be classified as trading?
Short-term.
Short-term investments that we're planning on selling soon. Well, we completely break the rule in this example because we want to see what happens over multiple periods. We're just trying to make this easy. The alternative would be we're buying and selling them all the time and we adjust them at the end of each period, and that becomes much more complicated. So to try to make it easier, we're going to pretend like these short-term investments are being held for 3 years, which should never happen, but we're going to pretend that's what's happening in this example. So we buy these 3 investments. These are the initial price we pay for them. At the end of the first year, these are the new values. How do we get these values?
Market.
We have a market, right? We know how many shares we own. We see what they're selling for. Multiply by how many shares. This is their value. Okay, so this is their market value at the end of this year. At the end of the next year, this is the new market values. And in the third year, we sold 2 of them during this third year, and 1 of them we continue to hold. And you'll see what those selling it looks like as we do this. So, for example, GE stock we bought for 200, it increased in value to 300, decreased down to 220, and then during this year we sold it, and et cetera for those 3. So, what we're going to do first is the initial record equity securities at the price paid to acquire them, typically including any brokerage fees. We're going to ignore that for this particular problem. And so we're going to record these separately so that we can keep track of how much we have in each account. So when we sell them, we'll know how much we need to remove. It'll make our life easier for what we're doing here. So our initial investment in GE stock, we're just going to debit, and we're just going to call it investment. But we are going to differentiate that this is for GE. And we're going to put $200,000 into that account. Obviously, we're going to pay cash $200,000 for that. And then we bought an investment in Cisco. And we paid $150,000, and we paid cash of $150,000. And then we have an investment in Intel. And we paid $400,000, cash of $400,000. All right, so initial, oops, too many zeros. So the initial entry, very straightforward. Whatever we paid for it, plus any brokerage fees, that's what's going to be put into our investment account on that date. That's also going to be the market value on that date, because that's what you pay, is the market value. Excuse me. All right, next, cash dividends from trading and available for sale securities are recognized as investment revenue. So, suppose that Kimball received, that's us, received $10,000 cash dividends from GE stock on this date. Prepare the journal entry. So, from our GE stock is paying out dividends of $10,000, and they received $10,000. So, did we receive all of the dividends that GE stock paid out? No. We received whatever portion that we own of all of the stock. That portion of the dividends is $10,000 in this case. So sometimes I'll present it, we own 10% of the shares, and they pay out $2 million of dividends, and you have to take $2 million times 10%, and you figure out that we got $200,000 in cash. So to keep that in mind, sometimes it'll be presented that way. So in this case, we received $10,000 in cash, and so we're going to debit cash of $10,000. And our credit is going to be investment revenue, or investment income is fine as well, of $10,000. That's going to go on our income statement, and it's going to increase our net income in this period. Any questions so far? All right. Part 3, at the end of each reporting period, make an entry to mark the investment account to market. And so we're going to do that at the end of year A and at the end of year B. So for example, our first one, GE stock went from $200,000 up to $300,000. And so for GE stock, we are not going to directly debit investment because I'm going to follow the example of the textbook, so as to not confuse, and they use an account called a fair value adjustment account. A fair value adjustment account basically either adds or subtracts to the initial investment account. If it's a debit balance, then it adds to the investment account. If it's a credit balance, then it decreases the balance. Does that make sense? Okay, so in the past, I have not done it that way, but I'm going to follow the example of the textbook and do it this way. I just use the investment account, and it's okay too. But I'm going to ask you to follow the example of the textbook as well. We're going to debit fair value adjustment. I'm going to shorten it to that, but feel free to write out the whole thing. Fair value adjustment for GE, and it's going to be $100,000 because we're moving from 200 up to 300. So when you take this account and add this account, you have the total investment account carrying value of $300,000, which is the market value as of this date. And we're going to have an unrealized gain that goes on the income statement of $100,000. Okay, so I'm going to differentiate with a little brackets and IS. When we're dealing with trading securities, this $100,000 goes on the income statement, increases our net income this period. That sound okay? Yes, sir.
Is the 100,000 for the fair value adjustment the difference between the 300 and the 200?
Yes, that's correct. Our second one is Cisco, which is going from 150 down to 100. So we're going to have a credit to fair value adjustment Cisco, the difference, which is $50,000. So when we create our balance sheet this year, we'll take the 150 minus this credit balance of fair value adjustment Cisco of 50, and we'll have $100,000 as our carrying value for this investment. Does everybody see that? Okay, and so we're going to debit an unrealized gain, loss, one of those two, I'm going to go with loss, which goes on the income statement of $50,000. So this investment, because it's a trading security and it changed value, it's going to affect our income statement. In this case, it's going to reduce net income by $50,000. And our last one, Intel stock, went up by $200,000. So once again, we'll debit fair value adjustment Intel for $200,000. We're going to have an unrealized gain, goes on the income statement, of $200,000. Everybody good with those?
I have a question.
Yeah.
For the unrealized gains and losses, are they put on the income statement as separate items?
They're almost always netted together. Yeah. Any other questions? That was a good question. At the end of our second period, 20B, we're going to do the same adjustments. This time for GE, we're going from 300 down to 220. And so we're going to reduce the fair value adjustment in GE. We currently have $100,000 in there. We're going to credit it 80 to reduce it. And we're going to have an unrealized loss. Goes on the income statement of $80,000. So quick review, what's an unrealized loss?
Reduce the amount to the income.
Okay, it does reduce, in this case, it reduces the net income. But specifically, what is realized versus unrealized?
You didn't actually sell the equity.
Perfect. Realized means we sold it. Unrealized just means it changed in value. Very good. So these are just changing in value. We have not sold them. We have not realized the loss or the gain. So what's going to be on our balance sheet for GE stock? How much? 220, the market value, right? This guy right here. How do we get that? Well, we have the 200 minus the 100, which gives us 100. Plus the 100, which gives us 300, minus the 80, which gives us 220. So it's investment. And then we have two of these guys with a net balance of a debit of 20. So we have the 220 sitting in as the carrying value of that investment. Did we see that? Okay. Our second one, Cisco stock, is moving from 100 up to 120. So essentially, we're going to get rid of part of this guy right here. So we're going to debit fair value adjustment in Cisco by 20,000, and we're going to have an unrealized gain. Goes on the income statement, 20,000. And then last but not least, our Intel stock went from 600 up to 650, so it increases once again. 50,000. We have an unrealized gain. Goes on the income statement of $50,000. All right. Next, we're going to sell some of these guys. On the next page, when trading securities are sold, we record the realized gain or loss. So realized because it was sold. The amount of the realized gain or loss is the sale price of the securities minus the original cost of the securities. You remove the current balance in the investment accounts and any fair value adjustment accounts as well, and the current balance in the unrealized holding gain and loss account, which I just said. Suppose that GE stock was sold for $230,000 on 8/1/20C. So in other words, this has already happened. We've already made these adjustments. Put it down here. And now we're in this third year. Period of time has passed, and we're selling these, which we're at the end of our previous period on our books for 220. We're now selling them for 230. First, we're going to record the cash that we received. We received cash of $230,000 when we sold these items. We are going to credit the initial investment account. How much did we initially put into this thing? 200, right? So in the investment account itself, all we have is the 200 we originally paid for it. So we're going to get rid of that, 200,000. And we're going to have a gain, a realized gain of the difference, which is 30,000. In other words, we bought it originally for 200, we're now selling it for 230. Our realized gain is 30. Does that make sense to everybody? All right. There's one more thing we need to do, but we're going to wait until the end of the period to do it. Why? Because I'm, again, following the example of the textbook, trying to be consistent with the textbook. You don't have to wait until the end of the period, but they do, and so I'm going to do that as well. And so when we get down here, we will deal with the fair value adjustment associated with GE, but we won't do that until we get down here. Okay? Suppose that Cisco stock was also sold for 105. So this other stock, the second one we have, was also sold prior to the end of 20C. It's on our books for 120. We originally paid, what, 150, and we're now selling it for 105. So we're going to debit the cash we received. We're going to have another debit up here. We have 105. We're going to get rid of the investment account for the amount that we originally paid for it. Investment in Cisco, which we paid 150. So our realized loss in this case is the difference, which is $45,000. We paid 150 when we originally bought it. When I was selling it for 105, it's a loss of 45, a realized loss of 45. This next part sometimes confuses students. It might take a little while to sink in and with some practice on your own, but I will do my best to explain it. Basically what happens at the end of 20C, two things need to happen. First, we need to, just like we did before, the one that we continue to hold, we need to make an adjustment for that one. So that one's, nothing new has happened with this one, same as what we've done previously, so this is the easy part. So Intel stock went from 650 up to 750, so we'll make the adjustment. So we're going to debit fair value adjustment in Intel, Intel, and it increased by another 100,000, and we're going to have an unrealized gain that goes on the income statement of 100,000. Okay, so nothing new there. We're just updating the one that we still hold, just like we did the previous 2 years. Now the new thing is the other two accounts are now gone. Those investments we've sold, we've taken them off of our books. Look, they're gone. They're no longer there. So does it make any sense to have a fair value adjustment account for something that does not exist anymore? Right? Just like it doesn't make sense to have accumulated depreciation for an asset you don't have anymore. You shouldn't have a contra asset or a adjunct asset for something that doesn't exist. So we're going to get rid of those two accounts. So what is the current balance in our fair value adjustment account for GE? $20,000, and is it a debit or a credit? Okay, so it's sitting on our books as a debit of $20,000. We want to get rid of it, so we're going to credit the fair value adjustment account for GE, $20,000, to get rid of it. On the other side, we're going to record an unrealized loss. It goes on the income statement in this case, for GE of $20,000. The reasoning behind this is essentially we have previously recorded an unrealized gain of 20, and we need to back that out by recording an unrealized loss of 20 in this period. That's essentially what we're doing. We're backing out previously a recorded unrealized gains or unrealized losses.
How do you get 10,000? How do you get 20?
That is the 100 that we created right here minus the 80 that we credited right here. So if you made a T account with fair value adjustment GE, you would have put 100 in it and then 80, and so we would have 20 sitting there. And so when we did this last adjustment, we went like this, and now 0.
Or the difference between the cost and whatever you most recently had the fair value at?
It's the amount in the fair value adjustment account. We'll stick with that,
Okay.
because it might be confusing otherwise. The other one that we sold is Cisco, and how much do we have sitting in that account? A what of 30,000?
Credit.
We have a credit of 30,000. In other words, we previously recorded a net gain of 30,000. And so we need to do, a net loss of 30,000, excuse me. And so we need to debit fair value adjustment in Cisco of 30,000 to get rid of that account. And at the same time, we're going to record an unrealized gain, goes on the income statement, of 30,000, basically to back out the previous unrealized loss that we recorded previously. Okay. So hopefully that makes a little bit of sense. I'm now going to add another reasoning behind what we just did, and hopefully this helps and does not detract from your understanding. So from the end of 20B to the time that we sold these items, during this period, we should be recording the difference between the 220 and how much we actually sold it for. So at the end of 20B, we had our books for 220, and we sold it for 230. So during this period, we should record a gain of 10, and that's exactly what we do. And how do we get to that gain of 10? Well, we have a gain of 30 and a loss of 20. The net effect is going from whatever we had at the end of the previous period to when the amount we sold it for. That is the net amount that we're going to be recording during this period. So in other words, this gain of 30 for GE, and then this loss of 20 for GE, the net is a gain of 10, which is the 220 to the 230. We'll do it again for the other one. For Cisco, it was on our books for 650. No, sorry, 120. And we sold it for 105. So what should we have during this period? A loss of 15, which is what we have. How do we get to the loss of 15? We have a loss of 45 and a gain of 30, which the net effect is a loss of 15. Okay, so the reason that we wanted to do it the way that we just did it and not do this in the same time we did this is not for this problem. With the trading securities, it doesn't matter if it's a realized or unrealized gain, they all go to the same place on the income statement. So it doesn't really matter for this problem, but when we do the next problem, they go different places. And so these guys, these unrealized ones will not affect net income, but the realized one will. So for this problem, it's less important that we separated these items, but for the next problem, when we do the available for sale, it will matter because they go to completely different places. All right, the last part of this problem, and in a lot of ways, probably the most important part for your understanding, is this part right here. So how would these transactions appear on the balance sheet, on the income statement, on the statement of cash flows? Assume no other transactions, and we're going to ignore taxes. Essentially what we're going to do is we're going to summarize all the stuff we just did on the last 2 pages into the net effect on the financial statements from owning these investments. Okay? So, from our income statement, obviously this is not everything that's going to be on our income statement, but just the items associated with these investments. We have investment income from dividends of how much and in what period? All the answers will come from the journal entry we just did. We had investment revenue or income of $10,000 in what period? In the first period. So our investment income from dividends is $10,000. How much do we have in 20B? None. How much do we have in 20C? None. Do you understand what we're doing? Okay. Gain or loss on sale of investments. Did we sell anything in 20A? No. So we can't have any there. Did we have any in 20B? No. Did we have any in 20C? Yes. How much? We had a gain of 30 and a loss of 45. So be a loss of 15. Very good. So in other words, the realized gains and losses that we had were a net of $15,000 loss from the gain of 30 and the loss of 45. Also on the income statement for this category is the unrealized holding gains and losses on investments. So for this one, since this is a trading securities, they're going to go on the income statement. If it was not trading securities, this would not be here. So for each period, we need to sum these up. So here we have a gain of 100, a loss of 50, and a gain of 200. So what's the net going to be? A gain of 250. Very good. So in our first period, we had an unrealized gain of 250. And since these are trading securities, this affects net income. So the net effect on our net income for having these investments is going to be $260,000. 10 from the dividends we received, and 250 from unrealized gains. Yes, maybe? Sort of? Say it again? What about in the second period? What do we have?
Loss of 10.
Loss of 10 is right, because we have a loss of 80 minus two losses that add up to 70. So we have two gains that add up to 70. So we have a loss of 10. That minus that minus that. So we have a loss of 10 in this period, or in other words, because we have these investments, the effect on our net income was a decrease in our net income of $10,000. All of that is coming from unrealized losses, gains and losses. What about our unrealized gains and losses in 20C? How much did we have in that last year?
10.
No? 110. Yep. So we have a gain of 100, and a gain of 30, minus a loss of 20, it's going to be a gain of 110. So we have 110, add the realized loss of 15, and the effect on our net income is going to be 95,000, obviously assuming we're ignoring any taxes. So it would be tax effects to some of this. So for holding these investments, these are the effects on our net income. Okay, now what's going to be on our balance sheet? So there's a couple ways we could do this. Yes, ma'am?
Could you explain 28 again?
28, which part?
The 260, how much you get?
I just added up the 250 plus the 10. Is that what you needed? Yeah, so these are just the summation of the things above it. So are you okay with the 250 and the 10? Okay, great. All right, so on our balance sheet, the things that are going to be affected are going to be a current asset, because these are trading securities. So we're going to have an investment asset. There's a couple ways of getting that number. We could add up all of these, plus add up all of our, in the first year, it would be this plus this plus this, plus this, plus, or minus that, plus that. That's one way of doing it. Or we can just know, what did we do here? What did we make the balance sheet items?
Fair value.
The fair value or the market value. So this summation, these numbers right here, has to be what goes on our balance sheet. The stuff we were doing down here was to make it these numbers. That's what we were doing. So if we add up all these numbers, which it adds up to exactly $1 million, that's the amount that must be on our balance sheet as this asset at the end of 20A. So again, if we wanted to, we could say 200 plus 150 plus 400 plus 100 plus 200 minus 50 equals $1 million. Same thing. At the end of 20B, we adjusted it with these adjustments right here to get us to these numbers. And so this number, which is 990, is going to be the amount that goes on our balance sheet, 990. What about the end of 20C? We only have one left. And we mark it to its fair value of 750, so 750 is what's going to be on our balance sheet. And so 750. So we're going to have current assets of these amounts on our balance sheet for our investments. These trading securities. All right, whenever we have net income, that affects retained earnings. So we want to see the effect on retained earnings. So in our first year, what's going to be the effect of retained earnings from having these investments?
No effect.
What's that?
No effect.
It will have an effect.
An increase of 10,000.
Nope.
Dividend,
260, right? All of this stuff is increasing our net income. When net income increases, it increases retained earnings. As we close net income to retained earnings. And so our retained earnings will increase by $260,000 because we have these investments. All right. In the next year, our retained earnings number will change by how much? decrease by 10. In other words, it's going to be 250. Very good. And then in the third year, it's going to increase by 95, and so it's going to be 345. Very good. So essentially, this 345, this retained earnings, is the accumulation of the 260, the negative 10, and the 95, all of the earnings that the company has had associated with these investments over these 3 years. I've never had a class that enjoyed investments.
So the retained earnings part is cumulative.
It is. It is for sure. One thing that I'll just mention about investments is that investments is a very deep hole to go down. There is a lot of accounting details, and we are just touching the top layer of investments here in this class. So when we deal with inventory, we're digging pretty deep down into inventory. When we're dealing with investments, we're on the very top layer of what happens with investments here in this class, because there's just so much that goes on with investments. We're just getting the big ideas here in this class. So, last but not least, statement of cash flows. So these are trading securities, and they're usually going to go in the operating section, so that's where we're going to stick them. So we received cash dividends in our first year of 10,000, and then nothing in the other 2 years. We purchased these investments in this first year for 750,000. We didn't buy any more, and then we sold some in our third year. We received cash of 335. All of the numbers that you see here essentially can come out of the journal entries we just did. Whenever we debited or credited cash, that's these numbers right here. So we debited cash there and there, therefore we have a cash number. In the first year, we bought them, so we had credited cash, so that's that. And we received cash when we had dividends, and so that went there. Yep.
Please, can you show the grade 35 again? The share of that?
This number? It's just the 230 plus the 105. 335. Just any debits or credits to cash go into the statement of cash flows. And if you want to, you could add these up. 740. We're done on time. 26. Any questions about this?
I have one question about, top of the page.
Uh-huh.
Well, you talked about the net effect for, the 2 different journal entries. At the top, the unrealized gain of 30,000. And then
The loss of-
unrealized loss of 20, down, yeah.
Oh, you're talking about, the unrealized loss of 30 and the gain, I would say
Yeah.
20 and
So
30,
the net effect was
gain of 10,
a gain of 10.
which is the fair value into the previous period compared to what we sold it for. In other words, our book value compared to the fair value.
Okay.
Normally, this chapter is spread over 2 class periods, but we're going to do the whole thing tonight. We do not have time to take a break, I'm sorry. I would like to take a break, but we have to keep going. Can you handle it? Are we going to be okay?